So I'm Jeffrey Sweeney, President and CEO of US Capital Global, and this is my good friend and client, Trevor here from Metals House, and we're gonna have a little chat about his bond offering that we've got, gold inventory bond offering, and he'll tell you more about his company. Trevor?
Thanks, Jeff. Appreciate it, and appreciate all you've done for us. Your team's done a great job in structuring a great product, and we definitely look forward to launching it. The thing should be live Monday. It's a bond that's issued that's backed by a senior secured loan that has a claim on the assets that we possess on our balance sheet, which is physical gold and cash. So basically, it's a much safer asset-backed product than what you may find elsewhere. It's more liquid than a real estate-backed product or a timber-backed product, and it's uncorrelated to most factors that exist in the world. It's uncorrelated to the stock market. It's uncorrelated to whether we have inflation or whether interest rates go up or down. So generally, it's a very safe mechanism to generate income with the safety of gold backing it.
But it's gold backed, so really all you have in a situation like this is counterparty risk, because the asset itself is fungible immediately, right? They sell it at Costco now.
Yeah, that's right.
And then the cash, is cash. So the only question is counterparty risk, and that's why I wanted to talk to you more so people get to know who you are, because the length of time you run the company, the audits that you guys have done, how highly regulated you are in the UAE domicile, and like that. So it's really, you're kind of looking at counterparty risk. So can you get a rate of return by lending on this asset that is really a good asset, and then how assured are we that you're a good guy? And I've known him now for 4 or 5 years now, I think.
Yeah, it's been a while.
But anyway, so what you guys have audits, and how's the structure of the company?
So first thing, at the fundamental level of the way that we generate money is we arbitrage a spread that exists in the gold market. So we're arbitraging gold as a commodity versus gold as a currency. So what happens is, once gold is in a very safe environment, it's insured, it's bonded, it's vaulted. That's when we release capital. So once we have capital, then we release capital.
So you buy it cheap at a discount and sell it at market.
That's right. And so we don't have any market risk in doing that. And then the asset is insured throughout the process. Wherever it is or whatever it may be doing, it's always insured, bonded, and it's very safe. Now, on top of that, we've got a very rigorous regulatory regime that we adhere to. So we've got regulators in many places that oversee what we do.
Well, you're regulated every domicile. Well, every domicile you do business, you're fully regulated in those.
Fully regulated, and it's so extreme now that
licensed.
We have to report every wire that we issue within 2 weeks to our regulator. We do a regulatory audit at our main trading hub, and we do a global consolidated audit with a Big Four accounting firm.
Yeah, well, you had one group, and then you changed groups. Who audits that?
KPMG has been the auditor.
I've heard of those guys.
Yeah, that's right.
And then so it's an arbitrage place. So then you buy it at a discount because you buy it close to the source, right?
Yeah, that's right. Gold is priced differently based on location and based on format. So gold that isn't 100% refined to good delivery standards generally is available at a lower price to the London spot market. And gold is priced differently in different locations based on a number of factors: what it costs to deliver, how hard it is to get there, so many different things. So generally there is, based on our infrastructure and our relationships, we're able to buy gold at a discount to the London spot price and then forward sell it. And so we lock in our profit the moment of execution.
So you get regulated and licensed in a particular supply domicile, like Peru, for instance, or some other place, and then you can deal with the miners there that offer a discount if you pay them at the door of your facility, right?
Yeah, that's right. I mean, we also adhere to banking regulators in those countries. We have to, verify and prove that we know the source. And we also have to verify and prove it once again to customs before a product leaves the country. And then we do it again when it arrives at a country. So it's, once again, very highly scrutinized and regulated.
So then, so the guy arrives at the door with gold, right? Duri, right? And then you assay it, right?
Correct.
And then after you verified the quality, then you give him cash at a discount.
Correct.
And then once it's inside your house, then you're like bonded and insured all the way to the refinery in Dubai. So once it's inside, you're bonded and insured. Once you take possession, then the transport is bonded and insured.
Correct.
Right? And then it arrives for the refinery, and that's, of course, they're big guys. They're bonded and insured. So it's really you've got a good collateralized pipeline all the way from the source.
Yeah, it's a great system. It's actually the same system that the Federal Reserve uses to move banknotes. So all very safe and insured throughout the process, as you said.
And then on the collateral management side, we have an agreement with the transport house that if there's a problem, we can take possession of the asset.
Yeah, that's right.
Same with the bank account.
That's right.
If there's a problem.
So when we built the structure, as you know, we put in a lot of mechanisms to give investors comfort. And one of the mechanisms is having US Capital Global as a collateral monitoring agent. So you guys monitor the collateral. There's a security trustee that is beholden to the investors to also monitor the collateral. There's a third-party technology firm called Alltrust that we report positions to weekly, and then they distribute a report to yourselves and the credit rating agency that is the one that's giving the credit rating. So there's a lot of monitoring going on to ensure that investors feel comfortable and that they're safe.
So the arbitrage is being able to buy this gold in another domicile at a discount and then sell it at market.
It's as simple as that. It really is.
But there's another arbitrage in here.
Sure.
And this is for the investors, because in the gold inventory business, there's a bit of a cartel, and the big banks will do gold inventory lines like this, but they'll only deal with the really big traders.
That's right.
And the smaller traders, the more middle market traders, are kind of cut out of that cartel because the big guys don't really want the competition. So there's a rate of return arbitrage opportunity to do a more of a middle market trader as opposed to the banks doing it cheaper to the really big traders. So there's two kinds of arbitrage. One is the materials itself, and the other is the fact that you guys aren't really big, so you're not available for really big bank lines.
We consider that to be a regulatory arbitrage. So for a small dealer or miner to open a bullion account at a large bullion bank, they would need to deposit about 8 million pounds, and the documentation's pretty extreme. So it'd be very difficult for them to do so. So we actually operate between sort of the smaller dealers or miners or operators and the big banks. So we have a reason to exist. Yeah, we operate in a very safe environment, and so there's a lot of ways that A, we protect the asset, and B, that the investors are certain that the asset's protected by having a lot of scrutiny and oversight.
Along similar principles, we brought in BNY Mellon as a custodian, the cash custodian. I think State Street's the transfer agent. So we tried to build counterparties around the lending structure that also were trusted, so that
Yeah, that's right. Bank of New York Mellon is the largest custodian on the planet. So they're the ones that actually hold the note on behalf of the investors. They pay the coupon, and they'll pay the money at the end of it. So you feel pretty comfortable with that. They also make it easy for, let's say, our RIAs to hold the note in their account because they also act as the transfer agent. So it's really a huge amount of comfort having a Bank of New York Mellon willing to custody our asset.
Well, we've tried to design a financial product that's kind of a step above a private placement by having counterparties, having it listed. You can buy it on, the exchanges in the U.S. investment advisors can buy it. You can buy it offshore really easy on the Euronext. I think it's in Germany.
It's going to be listed on the Vienna Stock Exchange.
Vienna Stock Exchange.
But yeah, you're right. So the mechanism for purchasing the note is DVP, delivery versus payment. So if you have a brokerage account, with money in the brokerage account, you can just instruct your broker to buy the note, and then it just shows up in your account, and the money is transferred from your account to Bank of New York. So it's very easy.
So we've tried, again, counterparty risk. We've tried to mitigate the best we can. I think we've done a very good job on that, in my opinion. And then we've also tried to make it easy to buy. Because there's another issue with private placements. They're not always listed. So investment advisors, they can buy this for their client and still maintain their AUM and their fees around AUM.
Yeah, that's right.
That's an important feature.
It is a very important feature. So the price will be quoted on Bloomberg, and as discussed, it's listed on the Vienna Stock Exchange, so that there will be a mark in that broker's portfolio every month, and it'll count towards their AUM.
Exactly. So I think that we're just trying to take these. We've done a lot of private placements over the years. And I'm really pushing to bring that whole marketplace up. Now, we did private placement for you as well. In fact, US Capital is we're an investor in some of these notes prior to us launching this bond. So you're a portfolio company. And we can buy it out of our fund. But we wanted to make it easier for other investment advisors to buy it. And if they're going to lose money or not get AUM fees, even if they're modest, by recommending their client buy an investment, they're less likely to recommend.
Yeah, agreed. I think by making it easier for the IAs to buy it, I think it really helps. It really helps their business. First of all, it's a great product. So they've got a product that's a diversifier that generates income that isn't correlated to other assets. So from a portfolio perspective, it's a great asset for them to put in there. Secondly, it's easy for them to buy. And thirdly, it's easy for them to market every month. So it's in the portfolio.
You know what it's
worth. You can see what it's worth. You can see what it is. So yeah, I think it's going to the next level of just a private placement.
Yeah, that was the goal.
Yeah,
We'll have more products like this in the pipelines. I think the private placement world, at least for middle market, we need to step up a little bit. I think it's been a little bit not as well structured in the past, I think.
Sure, and I think the other thing, as mentioned before, it's we're giving great transparency. So everybody involved in the transaction, whether it's an investor, whether it's the credit rating agency, whether it's your firm, you get weekly reports of all of our assets.
Your positions, yeah.
So it's giving everybody transparency, clarity, safety.
Almost real time.
Almost real time, and the security of having sort of a note that's backed by a better asset class. And when I say better asset class, it's highly liquid and uncorrelated to other asset classes. So there's a lot of
the asset is the bond itself is not liquid. It's a
correct
intermediate hold.
Yeah.
The other thing is it's a way to take exposure to gold for an interest rate. And a pretty decent interest rate. The coupon on the thing is like 9 something. Right?
It's 9.75.
So it's got a pretty good interest rate. Gold's it's a volatile commodity, but it trades within a pretty tight range. But you can either buy it and hold it yourself, but usually either have to put it in a safe in your house, or you got to pay to store it, right?
That's right.
And then you're subject to market fluctuations. Well, this way you can take exposure to the asset and make a pretty good fixed rate of return on it, because you guys turn it so fast, you just don't have that volatility, that market exposure.
That's right. And so we always operate a hedged book. So we don't take any market risk. We just capture the spread and make sure that we generate income for our investors. And that's the goal of the business. If you want gold exposure, the actual price exposure, there's other ways of doing it. We can help you do it, or you can do it through an ETF or whatever it may be.
Yeah.
But what we're doing is we're offering you a dollar-based product that generates income with the backing of the asset of gold.
Fixed yield product.
Yeah, fixed yield product with the safety of knowing that if something happens in the world, that you have the safety of having a prior claim on an asset that is highly liquid, that has 5,000 years of history of being regarded as money.
Yeah, right.
Right?
That's right. You're one of our most patient, best clients. I mean, you're kind of a long ball player, right?
Definitely a long ball player, yes.
And I think in the growth of your business, you've shown kind of a longer view, which is good for investors, right? Because you're not a transaction guy. You may transact gold, but you're really a relationship guy, taking a long view for building your company and providing returns to investors. And I've seen that in our relationship, and I really respect that.
Thank you. I appreciate that. And we also appreciate that you've been with us, for the ride for a long time as well. And look, in this world that we live in now, I think you have to take the longer view of what's happening structurally in the world and what makes sense. For us, being in this business long term makes a lot of sense, and we're going to be around for a long term. The idea for our business is to keep creating diversified streams of revenue that are generated in different geographical locations and different product styles, so that we create an all-weather portfolio of consistent revenue that we can generate for our investors.
In that sector. And also because of it's getting more and more regulated as time goes by.
Everything is.
So, which is good because you're always looking for, you think in this case it doesn't matter because it's gold backed, but for a business case, you've got a defensible space, and the regulators helping make you more defensible every day because you're already in the pipeline, you're already regulated, and it's really hard to get started in that business.
Yeah, I think you're right.
Some barriers to entry. You're not going to face a lot of competition on the ground.
Yeah, there's a lot of barriers to entry, and some days it may seem like it's too much or it's burdensome or whatever. But you're right. It ends up being a great thing for us because we sort of have first mover advantage in being a globally integrated company that does this, and the barriers are getting bigger and bigger, harder to start.
Yeah. And then, there's also an interesting, maybe you wouldn't think right away, but there's an ESG angle to what you're doing as well, because would get wax a little political here, but the tendencies of a lot of these developing countries in the past, they used to sell their resources to the big boys, right? And then they'd, get some kind of a stream off of it, but it was, fairly corrupt and didn't really benefit people at the top. And there's a lot of talk about stripping resources out of these developing countries from the past, colonial era, up until years ago, right? Now, but you guys deal primarily with the emerging trend in these countries is to develop their own economy, maintain control of their assets, and develop artisanal mines that help the local people maintain control. And so you guys facilitate the marketing of these products from artisanal mines. So it really supports the trend now to maintain control of the assets and help build the economy locally rather than just strip them out.
Yeah, that's right. There was a report that was commissioned by the World Bank about 10 years ago. And basically it suggested that if producing countries stopped giving licenses to large mining enterprises and they create a legal framework for the small and medium-sized miner, they would A, elevate the impoverished, B, reduce the environmental impact, and C, increase their GDP. So we've aligned ourselves with that movement, and we are very supportive of the small and medium-sized mining enterprise versus supporting the large mining enterprise.
You're kind of you were the head of the curve on that.
Well, I think we're a little early on it, but so far it's proven to be very successful, and we're very fortunate that we're in the business and that we've got a good position in the business. So we'll be here for a long time.
And then the artisanal mines you deal with, they're regulated too in countries, so they're environmentally more friendly and all that. You think?
Yeah, they're heavily regulated now, and every country's at a different stage of their legalization. In some countries, they have to get a monthly police report to prove that they are good actors. We have to prove that we know the source of every ounce, so that we have to actually physically spend time on their properties. We have to do a large amount of KYC and AML on every shareholder that's part of the mining enterprise. And we have to prove to the local banking regulator that we're dealing with legalized miners. And then the gold has to be legalized before it leaves the country, which means it pays a tax. So all of this stuff has to be proven in country first before the gold's allowed to leave. So there's definitely a large amount of process and oversight in country.
So, I mean, my opinion, I mean, as I've gotten, to know the model, this is a pretty ethical way to invest in gold. Because if you're buying shares in some massive mining company, I mean, that's an old school colonial model.
Yes.
This is a new school kind of ESG model, develops local economies, develops businesses, and supports local people, fully within the regulatory framework. So you're not, you don't have conflict gold, so to speak. So if you want exposure to fixed income in gold, it's kind of it might be one of the more ethical ways to do that, because the other stuff's a little uncertain as far as the ethics of it.
Yeah, no, I agree. I think there's one thing that's important, and that's making sure that we generate a return for our investors and our assets are safe for the investors. But the third thing is you also want to feel good about how you make your money.
Yeah.
And I think that the way that we make our money is supporting these early stage or smaller miners, which is better for the country and better for the population of the country.
Well, I mean, all the when we do transactions, we really like all the stakeholders at the table to do well. So I think this is one of those opportunities where, everybody at the table, from producer to investor to your firm and us, I mean, everybody is doing okay. You know what I mean? There's no one being taken advantage of here, which I like that.
Yeah, I think it's a fair model. The miners are happy because they've got somebody that gives them liquidity and some investment banking services, so to speak. And we're able to, do this in a fast, efficient way, which helps them because they need capital, they need liquidity. They can't go and list their company on a TSX or something like the large guys do. So they're happy. We're happy because we're able to generate this consistent income, and then our investors are happy because we're able to build products that are backed by physical gold that generate income, which is kind of a unique thing. As you said earlier, if you want to hold gold in a vault, there's a charge to it. So we basically flipped that equation. You de facto hold gold by having an investment in this bond, but you're generating income.
Yeah. It's even better than, I mean, you can loan your gold out too, but that has a pretty low coupon.
Correct. You can loan your gold if you find the right bank that's willing to deal with you. They'll pay you.
Size is an issue.
They'll pay you some small amount, like 2% per year for your gold.
Yeah. So I'm pretty enamored with this. I'm glad we've been working together so long. And again, we have U.S. Capital has a pretty good position in there.
Yeah, no, you're a good investor. You've been a good investor for a long time. We appreciate that.
Long hold,
and
like the return.
And we also appreciate all the work that's gone into the structure of this bond offering. I think a lot of people put a lot of time and effort into it. It's well structured. It's well designed. It makes a lot of sense for everybody. And I think the timing's right for us.
Gold is in the press. It's always in the press.
Yeah, gold's more.
And then we've got, with this product, we have a number of select dealer agreements with other broker dealers.
Yeah.
So we can distribute and distribute it in broker dealer channels. We've made it easy to buy for the investment advisors. They can buy it direct. So I'm pretty pleased with the way this is working out. Now, we have quite a bit of interest in it too, it seems.
Yeah, there's already interest. People keep calling, like, when's it going to launch? When's it going to launch? And you know how it is with lawyers. Things take a little bit longer. We expect that it'll go live probably Monday, Tuesday next week.
Yeah.
So we're ready to go. We're all excited.
So it's step up from just the average private placement by the counterparty, by the rating. Oftentimes the counterparties are good. I'm not questioning them, but we have name brand counterparties, which is a step up. And then also, instead of just like a due diligence report from some of these guys, we've got actually a credit rating. So it's all across the board. We've tried to move this thing up into just a little easier to buy, better quality. In fact, listed. things like that to make it just a little more attractive product than the average private placement. And our goal is to actually kind of try to lift up private placements and step them up a little bit in quality going forward, and quality of reporting and everything else. That's our mission.
It's definitely a good mission, and I think you've accomplished that in this case. And you're right. In private placements, if you're trying to sell to RIAs in the U.S., you pay somebody to do a research report for you, which is you're kind of in bed with them, and I don't know what it is. But this is
a due diligence report, which is valuable,
Yeah.
but it's not a rating.
This is much higher.
But
in
with a
terms of-
rating,
yeah.
you can really look at the risk rate of return. And if I'm not mistaken, the rate of return vis-a-vis the risk, the rating risk, there's a good margin over that rated product. The rate of return is higher.
It is.
If you were to buy a comparable product in the marketplace, you have a lower rate of return.
That's right. So for, let's say, a big brand name company that has a similar rating, they would have a lower credit rating, a lower credit spread.
Yeah.
We decided to put a decent premium over the coupon that would be issued for a traditional B-, triple B-, so that our investors are encouraged and are well rewarded.
Yeah, no, I think that makes a lot of sense. Well, we're talking about kind of an upgrade to the average private placement, right? By having it listed, strong counterparties, with BNY and things of that nature. And then also we've taken the step to have it rated, so it's a rated product by a kind of an ESMA model, which is the rating agency standard for ratings. So that's given it. See, now you can compare it for risk rate of return. I think it's with what is it? Triple B.
Triple B-.
Triple B-.
Which is investment grade.
Yeah.
So a couple of things. I think it opens up a bigger available universe of investors, because there would be some fund managers or some other investors that would need a credit rating. Mm-hmm. So that's one aspect. And I think it also adds another layer of comfort for investors, because not only do we have the regulator, the auditor, you guys monitoring us, the trustees monitoring us, the credit rating agency now monitors us.
Yeah.
So the credit rating agency has given us an initial rating, but they're going to continually monitor us, and they will reassess the credit rating over time.
Yeah, like the typical rating.
Yeah, so it's good for investors. It's good for us, and I think they spend a lot of time analyzing our business and understanding our business to be able to come up with their credit rating.
I think the rating, I have a feeling as you get bigger, it'll improve the rating. I think the rating actually is very good, but I think size-wise is why it's slightly lower. I think as you get bigger, it'll just get better. Because the fundamentals of the business are really very good.
Yeah, I think so. I think once we're successful with this bond launch, and we're putting greater amounts of capital to work, that we will have an increase in the bond rating. We're motivated, and we're looking forward to moving forward. Right. And we're looking forward to continuing the long-term relationship that we've got with you and your team. And we're looking forward to this being a success.
Yeah, no, I think so. I'm pretty happy about that. Well, thanks, Trevor.
Thank you,
pleasure.
Jeff. Appreciate the time.
Good to see you.
Yeah, good to see you.
And will you come out and hang out with me in Dubai? And I see you here in Miami.
Yeah, of course. We'll be there.
All that.